Good afternoon, Ezaih Camp 2024. So we are here, day one, and today our main topic is introducing ourselves to the Forex charts. I've dropped some tape reading videos now, but before we get into the tape reading, I just want everyone to, this is a mentorship, this is not a course, this is a mentorship. So let's have a few words before we move into this mentorship. Now, you're watching this video, you're here to make money, you're here to master Forex. Take a deep breath and relax. And the reason why I'm saying that is because let's look at the facts right now. You're in the Forex markets, right? And after these 30 days, you're going to be in a position where you're going to buy a funded account or you're going to invest into a personal account, right? And you've placed yourself in the war. You're not contemplating whether to go to war or not. You are in the war. Now, there's two ways this war can go, right? And it's factual. The first way is you lose, and you lose the war and you go back home, right? The second way is that you fight the war and you understand it's going to be a long war. You understand that victory lies ahead of you, but you understand that the pathway to that victory is not going to be, not specifically that it's not going to be easy, but it's going to take some time. This war cannot be won over the next week, over the next month, or even over the next 6 months. This war is a year-long war, okay? And if we succeed in, fighting this year-long war, we can now proceed on to moving into the second year where we will achieve victory. First of all, even if we get through the first year, even if you get through the first year, you're in a state of victory. But forget about winning, let's talk about losing. You lose the war, you're back home. And you're going to go fight the war again and you're back home. Eventually, your country is not going to be on the map anymore. You're not going to be on the map anymore. And this is why we're here. This is why Ezaih Mentorship is here. To make you fight this war. So, relax. Calm down and just take into consideration that whatever we're going to be learning in the mentorship, this is going to be crucial. However, I'm going to be providing the steps that you are going to need in order to win this war. Now, the reason why I'm taking a very relaxed approach today, confident approach today, is because the actual trading is very low paced and very calm and relaxed. It makes you a very calm person as opposed to how the industry makes you feel about it, right? In terms of even, let's say, for example, how this mentorship started. We had a cut-off date. Everything happened so fast. This was just the way it's happened for Ezaih Camp 2024. Everything's happened very fast. Everything's happened within the last month. It's been very fast-paced. We've dropped tape reading videos. Every single person's been covering it every single day. It's been very fast-paced. But now in day one of the mentorship, I want every single person to understand that this relaxed approach that we're going to take into trading is what's going to make us successful and different from a lot of people. Now, the reason why is because with a lot of strategies that are out on the market right now, right, they're very fast-paced. They require to be pinpoint accurate. You have to watch for this in the market, that in the market. You have to execute at this point. We're not going to be doing that. All we're going to be doing is, first of all, in these first 5 to 10 days, right, what we're going to be covering is what we covered in the tape reading videos, but literally section for section, we're going to break it down. And every single day, we're not going to try to do the most. What we're going to try to do is we're going to try to confirm and consolidate topics. And I'm going to send you back to the charts. And this is really artwork, right? This is artwork because the way the markets move, a lot of you guys can understand now that this is pure art. It's beauty. Right? And if you have a very positive approach and a confident approach to this, you find it beautiful too. The charts stress a lot of people out because, first of all, they can't figure it out. Secondly, because they're risking too much. And because of this high risk approach that they're taking, when they look at a chart, they don't find it attractive. They don't find it beautiful. It stresses them out. They find it ugly. They don't want to be there doing that, but they're forced to be there doing that because they've lost a lot of money in Forex, or they want to make money, but they don't respect their hustle. We respect our hustle. We appreciate the markets. If the markets wasn't here, we wouldn't be here to be able to trade it, right? Trading is a beautiful thing. So we're bringing beautiful back in trading. Now, today we're going to get straight into it. We're going to get into ranges. Now, what are ranges? So for me, how do I identify a range personally? I say a range is my workplace. All right. The range is a area within the market where I allow my thought process to flow out. Now, my range, it allows me to kind of foresee potential moves in the market. Remember, I said potential because we don't know where the market is going to go. So the range identification is the most important framework that you need in order to set out and analyze the market. So now we're going to go straight into it, and we're going to move the camera right here. Come on, production quality, you know what I mean? So right now in front of us we have GBP USD. Now the first thing I will do when I jump into the market is I'll go onto my 4 hour. Now remember, time frames are fractal, and it doesn't matter which time frame you are using, right? The only reason I'm using the 4 hour, why am I using? Because I want to get a wider display of the market. Now, whether you're being on the 4 hour, the 1 hour, the liquidity levels will remain the same. The candlesticks may look a little different. You might get different fair value gaps. And remember, a lot of people are mentioning fair value gaps in the group. I respect the efforts. However, you let me explain to you what a fair value gap is. So don't try to dive into fair value gaps too much. Let's take it step by step, build the foundation like we did in prep topics 1 to 5. So if you went through prep topics 1 to 5, remember how I built the foundation in you guys? This is the same thing we're going to be doing here. So pay attention to this, right? Because you're replicating what I'm doing. So the very first thing that I will be doing when I enter the market is I'll be going into the let's say we're going onto the daily. Now when I go into the daily, okay, I want to identify a high and a low price, and this needs to be very recent. I don't want to, so let's say for example, this is a daily chart here. I'm not going to look here and identify my range from here. Why? Because these liquidity levels that have been printed, right, they are from before history. I want to look at the most recent price ranges, right? And the most recent price ranges for me is this high price here, and then this low price here. Now instantly, as soon as we mark this high and low price, if we go into the 4 hour, if you watch the tape reading videos, we've narrowed it down. So we've got this high price and we have this low price. Okay, right, cool. Let's go into the 1 hour now. Now, if we go into the 1 hour, look how beautiful that range looks. So we have this high price here, and then we have this low price here. Let's go into the 30 minute. Again, look how beautiful it looks. We have our high price here and our low price here. Now, what is the importance of a range? Okay, so what is the importance of a range? So in between your range, where you have your high price and where you have your low price, what happens in between this range? We have price action taking place, right? So we are going to say, what happens inside the range? Price action. Now, this is very important. What is price action? So price action is the constant dance between buyers and sellers, right? And the constant placement of buy orders and sell orders. Not a lot of institutions and hedge funds, they don't do market execution. Most of these institutions are doing buy limits, sell limits, buy stops and sell stops. And this is something we are also going to cover today, but I'm not going to explain that. I'm going to give you guys a YouTube video to watch what a buy stop is, sell stop is, or what a buy limit is, sell limit is. It's a very simple concept, but there's some places online that probably explain it better than I do. But what we're going to do is we're going to focus on the price action. Now, price action. The price action is happening within the range. Now, what the price action creates is within the range. So let's say, for example, we've got our high price and we've got our low price. Price action is bouncing within the range. Price action creates multiple opportunities, as we see. So what we trade every single day, we are most likely trading within the range, right? And inside this range, what we can see is, let's say, for example, we look at this range right now. So we're going to go into the 1 hour to look at this range. Now this is our range in front of us. What can we see? So price started from here, okay? Now, I know there's some beginners in here, so we're going to be very basic with it. We have this blue candle. For me, this blue candle is a bullish candle. My black candle is a bearish candle. Bullish means buy, bearish means sell. So bears, bearish patterns means sell patterns. It's another word for it. Bull, bullish, bulls, that's buy patterns, okay? So we have this bullish candle here. Prints a high price, which is, if we mark it out, 1.28271. Now, for the first day, I want you guys to be able to talk to yourself in your minds and forget about where the price is going for now. I want you to be able to describe in your head to yourself exactly what's happening within the range. Now, this is me thinking out loud. So whatever you see on the screen right now is me thinking out loud. And this is a process that you should be able to replicate. Okay. So price has printed this high price. Okay. And this is the highest price that we can see available within this price range. Okay. Now, this is how we've marked our high price. This is how you break down the range now. And this is called range consolidation. So we've identified the range as a high and low price. Okay. Now we're going to break down the range, okay? So, we go candle for candle and we go move for move. So, on the 1 hour time frame, price prints this high. Then where does price move to? Price moves to this level here. Why does it move to this? Why have I chosen this level here? Because this is a blue candle. Now, this is a black candle, and then a blue candle. If we look at the candlesticks, what do these candlesticks mean? Now, roughly, this candlestick means it's pushed up. This candlestick following, with the wick coming down here. And remember, if you saw on the beginner video what is a candlestick, we know that this is our open price, this is our closing price. This is a bearish candle because the closing price was lower than the open price. And this wick is here because this is the lowest point in price that it went within the hour. However, when the hour closed, the price closed here. So what does this mean if we're trying to identify how this candle moved? We can see that the price went all the way down to here, then it closed above here. Now this wick, what does this wick mean? This wick means that the price carried on pushing up to here. However, price went further down, then it closed above here. Okay? This is the mental process. You should be able to kind of map out. Looking at candlesticks, you should be able to extract the data and kind of understand the form of movement that has taken place just by looking at the candlestick. All right. Now I've kind of shown you an example. Now this is going to take a lot of practice, okay? Because again, you're programming your brain. And before we get into the FVGs and strategy building and, you know, the ins and outs, I want you guys to kind of align and program your brain in a very relaxed manner and try to fall in love with the charts and understand how they move. Because once you understand how they move, this is when you can further progress and develop a really deep understanding of the markets and what's happening. And that's what we're going to be at the end of this mentorship. We're going to have a very strong focus and very strong reading levels, reading skills. That's the most important thing. So again, now this is the first move of the range. So obviously we've come down to here. But then we have a big move. High volume move. Now, why do I call this high volume? Because the candlesticks are significantly larger, right? The candlesticks are significantly larger. So, larger candlesticks means higher volume. Smaller candlesticks like this, for example, this means low volume, right? But we can see a high volume move. Now, this high volume move has taken out previous liquidity. Now, if you've studied tape reading 1, tape reading 2, and tape reading 3, we can see that we know that underneath underneath lows that we find on the wicks, there are orders that need to be collected in the form of buy orders or sell orders. So we can see that the price pushed and it collected what? It collected buy orders. Now, furthermore, if we just dissect this range a bit more, and we'll just move at a bit of a faster pace now. Price comes all the way down to where? Here, okay? Then it pushes up. What does it create? Price creates a high, then it creates a low. Then it creates a lower high, which is here, okay? Now, how is this? So we're dissecting the range. So we want to look at each piece of evidence. Now, what we can see is, how did this candlestick move? So this candlestick came down, up, down, right? And then the blue candlestick pushed up. Then we had this, and then we pushed down again. This replicates exactly what happened there, right? Because look at this wick. One, price comes all the way down and closes here. Wick comes down. Then price pushes up. Bullish candle. Does it break this? Does it break that previous wick? No. Does this candle break that previous wick? No. So we have created what? Equal highs, as we covered in the tape reading, liquidity point, or area of liquidity. Now, furthermore, we created this lower low, okay? Now, again, relaxed approach. Look at the liquidity build up. Let's zoom into here. One, two. Now, people would say this is a lower low, but from the tape readings, what do we understand from this situation? We understand from this situation that because we had a buy side range in the form of here, so 1, 2, and we had highs in the same vicinity. Now look at the vicinity of this. This high and this high was at a similar price, okay? Now, we already know that above a high, liquidity exists. But if we get two highs, that means there's double liquidity basically. And that double liquidity basically means there are a lot of buy or sell orders above or below this point, which means that there is a probability that the price can push towards this point. And remember, trading is a game of probabilities. We're not looking to be right all the time here. Our main objective is, again, we're in the war now. We're either going to win or lose. So having said that, our main aim is to make sure that we fire our bullets, and bullets we covered in prep topics 1 and 2. We fire our bullets in the most high probable areas. Now, in order to get a high probability trade, we need to take into factor the surroundings of where we're firing our bullet. We need to take into factor the considerations where our target is going to be. And we need to ensure that the intention behind this trade is because we are placing this trade for the highest probability. We have the correct evidence ensuring that, you know, we have this liquidity point above here. We have this entry requirement that has been fulfilled here. So the probability of this reaching my target is extremely logical and it makes sense. And that's what makes a high probability trade. If you continue to shoot bullets in high probability in high probability scenarios, again, we're in this war, so we're going to fire our bullets anyway. But if we're firing our bullets in high probability scenarios, the likelihood that we're going to survive and continue to fight this war is going to be much higher than whether we're going to blow our account. And remember, with our risk parameters, where we're risking 0.2%, we're not going to be at a level of stress, so we have enough bullets. Does that make sense? So moving on, we can see that 1, 2, we had a build-up of liquidity underneath here. Why did we have a build-up liquidity underneath here? Because we had equal lows. Now what happens after? Price pushes down. Cool. Let's go back into the 1 hour. Oh, I can just do this, sorry. No. Alright, cool. So, price pushes down, comes back up. Now, again, ranges. I'm going to get rid of this, just clean it up. Alright, cool. So we identified liquidity point above here and liquidity point below here. Okay. Price pushes down. Now, when this price pushes down, it creates another low point right here. Okay. Now look, are there 100 points in the market we're looking at, or are there only 3 to 4 points in the market we're looking at? Have a very close look at the chart. We have dissected this based on the evidence that's in front of us, but how many points are we really looking at? We've looked at 1 point, we've looked at 2 point, we've looked at 3 point. Are we looking at 10 different points, or are we looking at 3 different prices of interest? Okay, cool. Now, within this now, another range has been created, right? Ranges are constantly formed in the market. People try to force ranges. We don't force ranges. We draw ranges on what we see. Now, how has this range been created? We still have this high price. So 1, 2, remember, we had liquidity above this region here, okay? Now, price pushed down, took the buy orders, and created this low here. After that, price pushed up, okay? So, this means below this level, what is there now? Below this level, there is liquidity. Because remember, below prices, high and low prices, there is always going to be buy orders and sell orders, right? And this is in most recent markets. Let's say, for example, I take a low from here. The orders below this level are kind of irrelevant to me because the banks are not looking at 10 days ago. Or I say the banks, but the market is not looking for 10 days ago. The market is looking for recent price action and recent ranges. That's how the market operates, right? And that's the number one mistake retail traders make, because when you see retail traders trading, and when we were in the beginning trading, we were like, I found myself looking like 10 years back for that magical support and resistance line to base my trade off. Does that make sense? We're going all the way into the daily thinking we're going to find out something that people don't know. But really and truly, the market is based on current price action. Does that make sense? So, range creation, we have already created another range within the range. Again, this is our operational area. This is where we're going to be placing our trades. So, we can see that from this low point, okay, we have created this high point. Now, this is our working area. Why is this our working area? Because now there's probability that price can push above here because there's liquidity above this level, and there's liquidity below this low here. All right. So let's say, for example, in this scenario now, price has reached here. There's two situations that can happen because, again, we have our high and low range, right? So we have the high of the range, we have the low of the range. On the higher time frame, we have this high, and on the lower time frame, we have this low here. So we can already map out roughly either price is going to come down to here, or price is going to push past here. Okay, but we don't want to start predicting the price number. All we want to do is just analyze the market and focus on range and narrative building. What we're doing here is narrative building. I don't want you guys to look at this chart and say, okay, cool, if I'm a good trader, I should be able to predict where this is going to go. No, bro. You just need to learn to read the market and be able to narrate the story. Once you can narrate the story, because this story happens over and over again, there will be a period where you'll be narrating in hindsight. Then there's going to be a period where you can narrate in real time. However, if you can't narrate in hindsight, if you can't explain to me exactly why this happened or that happened, how are you going to do it in real life? Right? That's the difference. A lot of people shame being able to narrate in hindsight. No. This is your key fund. You're wiring your brain to think a certain way. And this process that we're going to be going through, and this process that I'm doing right now, I just literally want you to do this. You select a specific piece of price action and do the same thing I'm doing. Because this is how I developed myself. I started, because I looked at the charts and I was like, you know what? There's definitely a way. There's definitely something happening here that can be repeated, but I just need to be able to find out where it is. So I started narrating the charts to myself, and once I started narrating my charts to myself and started telling the story, I realized that there's repetitiveness in the story. And once I identified the repetitiveness, this is how I disciplined myself and I built myself into the trader I am today. Because now, instead of narrating in hindsight, I can narrate in real time, and that's what it took. So that's what I'm putting you guys through. So again, what we can see here is either price can push up to that level there, either price can push up to this level here. What happens in this situation? Okay, cool. So again, this is our range. Now within this range, what has happened? always say, what has happened? What has happened? So market has printed liquidity here. So 1, 2, 3, 4, 5, and then we get that push here. Now, if we were to narrate exactly what was happening here, again, we had our high price, we had our low price, price shifted lower, right, and price came down to this level here. So it came down to 1.27124. Our higher price is 1.27754. Price came all the way up within this range, right? Failed to grab buy side orders. What do I mean by buy side orders? It failed to grab the orders above this range. If it succeeded in grabbing buy side orders, right, we would see price come up here. This is what I would say is successful in grabbing the the buy side orders and collecting the sellers. But in this situation, it failed to grab buy side orders. Okay. Furthermore, after that, what happened? We had what is this move? What do we classify this move as? Okay, this move here. What do we classify this move as? We classify this move as a high volume sell. No need to call it no fancy words. This is just a high volume sell, right? Why do we call it high volume? So if we look at the candles here, what would we call this? We call this low volume. In low volume markets, you can already imagine, but because there's so much time that it takes for it to let's say, for example, let's look at the time. 9 hours and 45 minutes. So in this 9 hours and 45 minutes, the whole world economy is trading the pound US dollar. So how many orders do you think are built up below and above? That makes sense. So even that is a gem in itself. The longer it takes for like a currency to move, the more orders are going to be built, of course, with time, because a lot of people are, the retail traders are getting frustrated. Maybe some of the institutions are getting frustrated. They're placing huge buy orders above and huge sell orders below, or however you want to call it. Now, what happens is, as soon as we reach the top, we have this buy side, we have the sell side move, and this sell side move was a high volume sell. Now, let's just look at the tape readings, right? In terms of the tape readings, what did we cover? We covered buy side and sell side liquidity. Now this is a range within the range. Now let's look at this. People look at this in different ways. Let me show you how I see this as, in terms of narration. So this is our range, okay? But if we look deeper, we see point. So this is what I'm saying. Train your eyes. What can we see here? Again, what did I tell you guys to do? I told you guys to, when you see the candlesticks, try to figure out the move. So look at this point. So price comes down here, it comes up, comes down here, boom, and then boom. Okay. So 1, 2 highs in pretty much the same vicinity, not too similar, but it's in the same vicinity. Then the price does this. Price comes back up to here, then it goes down. Okay. So 1, 2, 3. 3 highs. What do we have above those 3 highs? Liquidity. Okay. So because we have liquidity, what can we do? We can kind of section this now. We can kind of say, so above these highs, we have liquidity, and below this set of low, we also have liquidity. Obviously, this range is still valid. The overall range is still valid. However, the recent price action, we can see 2 equal highs, or 2 highs in the same vicinity, and then we have that, 1 low, and below this low, we have liquidity in the form of higher low. So 1, 2, 3, 4. And remember, when the price is constantly moving like this, like it's moving like that, and we see it very often, there's constant orders being placed underneath, right? And these are orders from the market that need to be taken. Okay, so in turn, these are sell side orders that need to be taken. So what do we see here? This was a retracement within the range. People call it this, that, etc., etc. But if we look at the context and we look at the narrative, because we had 1, 2, 3, we can now add the narrative that buy side, there's orders above this region here. Okay, so what does the market do? The market pushes. Now, as a retail trader, also put this into your market psychology. How big are people's stop losses going to be? 10 pips, right? Or let's say 15 pips. So you can already see the market knows that most of the orders are going to be located. So let me let you guys in. You see, when a stop loss, so when we're trading, we just see a stop loss as our losses are being limited. Really and truly, what a stop loss is, let's say for example we execute a buy in our broker and it hits stop loss. That just means that a sell was placed to close our buy, which means another form of order was used to close our buy. So let's say for example you're in a sell, right, and your sell hits stop loss. What is your stop loss? Your stop loss isn't really a stop loss. Your stop loss is just a buy order that closes your sell order at a loss. If you're in a sell and it hits stop loss, it's just a buy order that closes. So stop losses, what are stop losses? They're actually what? Orders, right? So then you have to understand where are most of the orders located in the market, 10 or 20 pips above the previous high. And if you actually look at the markets and you try to, when you narrate the stories to yourself tonight, you'll be able to kind of tell that 10, 15 pips is kind of the standard amount that the buy side and liquidity sweeps, they kind of deviate, right? And this will help you in real-time market narration. Anyway, moving on, what happens? Market does this buy side sweep, but again within the range, so it fails to grab buy side orders. Okay, so obviously because this is moving up, our next target would have been, you know, here, or this would be something that we would have been waiting for, as you know, liquidity lies above here, but fails to grab buy side orders. What is the next narration of this story? Price pushes down high volume. What does it do? It takes out all these orders above here, below here, 1, 2, 3, 4, and what does it do? It does the sell side. Okay, now in the realm of repetitiveness, right, if you were to catch this move, we have full logic behind it, right? If you were to catch this move, let's say for example you caught this move here, 20 pip stop loss, and you were to close it here, 1 to 2 R. Let's say for example you were to execute 1 to 2 R. Let's talk about this in terms of, obviously this is a little bit of information. Now we're gonna have a little bit of talk. 2R. If you could do 2R or 3R per day every 2 days, and you could average around 8R to 10R, okay, and the target is to catch 40R to pass your phase 1. I think about this every day because it's so beautiful. But if your target was 8R to pass your a week to pass your phase 1, so obviously 40R in total, and the war was so relaxed and easy like this, where you had narrative, you had logic, and you had explanation behind every single trade. And when you lose for a reason, because maybe you slipped up. Because remember, it's like Andrew Tate says, if you take a loss, you're accountable for that loss. There's definitely somewhere you went wrong in order for that loss to go. And once you start studying accountability, this is when you start improving your trading as well. Remember, like every single trade you place, you're going to get better and better and better and better as a trader. Right, but this can only happen if you focus on the development. If you try to understand where your losses went wrong, and then when you try to understand how your winners actually, like, did your winners make logical sense, or was it a gamble? If it was a gamble, you need to go back to the drawing board and understand why you won that trade. If you don't have no logic on why you won that trade, that move, you brush it aside as a gamble. It's not part of your trading plan, right? Most of the trades that you want to do, they need to have logical explanation, and once you have logical explanation, you're going to eliminate the fear factor. You're going to eliminate the anxiety that you feel when you're in the trade, because you have logical reasoning. And where do you build that logical reasoning from? You build it from this narration exercise that we're going to do. How many charts or how many scenarios do you think I've narrated in my trading career? Thousands, right? So this is why I can trade live or have this confidence to do what I do, is because I've just seen these scenarios. This is scenario narration, whatever you want to call it. I've seen these scenarios happen time and time again. So when you guys look at me and say, oh, Ezaih must be a talented or gifted trader, no, I'm just very experienced, and I've narrated so many scenarios and situations that have happened in the market, that now when I'm breaking down this chart to you, I'm picking out the little pieces of evidence and I'm giving you logic and reasoning behind why this happened. Does that make sense? And obviously, you guys have been trading every single day. You guys understand this is very repeatable. This stuff happens every single day. And because it happens every single day, we have our keyword, which is repeatability in the market. We know to fight this war, we can shoot targets. We have that. Now we know it's scalable. What's left to do? Be able to spot this narrative, be able to execute it properly, and just carry on with the journey. right? Forget about doing this as quick as possible. Just do it. Forget about the time. Don't worry how quick you do it or how slow you do it. Just do it, right? Let the money come in at its own pace, at your own pace. Now, moving on, let's go back into the markets. So again, we're doing range building today, so let's just get out of this. Okay, cool. Now, okay, price comes down. Price does a sell side liquidity sweep, right? Then what does the price do? The price pushes back up. Now, within the range, if we draw it clearer, you can see that price comes back in, does that sell side liquidity sweep, it goes back up. Where does it go back to? So now this is when, if you watch prep topic 3, we're going to get into this tomorrow. So we're going to get into the use of the Fibonacci situation tomorrow. This is tomorrow's thing. But I just want you to draw this tool on your charts, have the 50% level marked, and identify what happens around the 50% level in the price ranges, okay? So if we were to draw on the higher, higher to low, 50% level is where? The 50% level is here, okay? I just want you to analyze. I just want you to see what happens at the 50% level in the price range, okay? But obviously we're gonna move on with what we were doing. So again, price range. Now, moving on, what does the price do? So overall, price comes, and if we look at the previous price range to this area, it is this high, and obviously, where's the low? The low price is just around here, okay? So what does the price do? The price does the buy side sweep on the higher time frame. It comes all the way down and it fulfills the whole range. So you can see that this whole range was present. What has the range done? The range has been fulfilled, and that's why range is important to identify sell side targets. You know, the ultimate sell side target was here. What was underneath these lows? We had liquidity. All liquidity was taken in one big sweep. One, two, like literally let's zoom in. You can see the whole of liquidity was taken in one sweep. So all of this price action, all the orders below here, were taken in one sweep. Okay. Now I'm just gonna dive into why these are liquidity orders. Again, look. Below this region here, 1, 2, 3, there are sell side orders. So remember, if you're in a buy in the market, in order to close your buy, or in order to cash out, you need to find a seller. If you're going to sell, in order to cash out, you need to find a buyer. And this is exactly what's happening. So we have orders that are most likely placed here because this is in the same vicinity. Now, if we look further here, 2, 1, 2, 3, 4, all in the same vicinity. So we have orders here, okay? We have orders here. Look, everything's in the same vicinity. We have orders below here. 1, 2. These orders got taken, but then we have orders here. All right. Oops. And the price pushes up. Okay. So, what does the market do here? So, when the market does that buy side sweep, it collects sell orders, right? And now these sell orders need to be offloaded. If I was smart and I was an institutional trader and I was smart and I was a seller looking to take some, I was a buyer looking to take people's sell positions, where would I position myself? I would position myself at the cheapest price possible. Now, what is the cheapest price possible? The cheapest price possible, which is going to be lower, obviously, right? So if I was a buyer, remember, buy low and sell high, the basic fundamentals of Forex, right? So I would be looking to place my buys where? At the lowest order point. Now, because we've broken down where the orders are placed in the market, the lowest point is really and truly here. Okay, now watch how the market reacts. Not this low point. Forget about this low point. I'm talking about that low point. Because why? Because we had 1, 2, 3 highs. That's how I identified them. I identified them at logical areas. This makes logical sense. Why? Because we had 3 lows in the same place. Let's look at what the market does. Very, very carefully. I'm going to mark this. I'm going to put 10 pips here. So 10 pips. Okay, so we're going to extend this candle rectangle for 10 pips, just a bit lower. Okay, cool. Watch what happens. Look how price eats the orders. Eats. Where does it slow down though, guys? Yeah, where does the price slow down? Here. Let's look at it again. Pushes like an animal all the way. Where does the price slow down though? The final place of liquidity, or the final place of order grabbing within the range. Okay, where is our range? The range is our high and low price. And the reason why we identify our range is to break down the price action, right? So if we didn't have a range, we'd be trying to dissect the price action here or here or here. What a range allows us to do is allows us to basically narrow down our search for opportunities and targets. Excuse me. So, this is what I want you guys to understand now. When narrating your story in the markets, why does the price slow down here? Because the orders have been grabbed. All the sellers have exited the market and found their buyers, which means, and that's the only logical explanation you can provide between the volume shift. So this is high volume, and what happens? We enter low volume. Then obviously the price continues to do whatever it wants to do, etc., etc. But this is our range fulfilled. Okay. Now, can you see how I've narrated this? And can you see the kind of identification I've done within the range? So let's go on to the 30-minute. I have been able to explain to you exactly what has been printed here. So this side of the market. Then I was able to draw a previous range, so this high and low price, okay? And I was able to explain the liquidity print, 1, 2, 3, 4, 5. Then I was able to explain what's happened here, and this is price breaching previous high, where's the previous high? This is the previous high of the range. Okay, and we would call this a buy side sweep because the price has significantly violated the previous high, which is here. Okay, buy side sweep. Now, obviously we've drawn a 50% level, which is special because look at that. But anyway, moving on. Then I've been able to narrate to you the liquidity printing from the get-go. So we had highs in the same vicinity, then we had lows in the same vicinity. Price came down, swept that, came back up. Then price created its own liquidity, so 1, 2, 3, 4, and then we created a new low like that. Then we created liquidity prints there, right? What does price do? Price, and then we created area of liquidity here. What does price do? Price takes the buy side, then it takes the sell side. Okay, then price returns to the 50% mark within the range. Then what does price do? The price creates more liquidity, 1, 2, 3, 4. So if we look closer in here, what we can see is equal lows, and we can see liquidity prints, 1, 2, 3. Right, orders. What's below these lows here? Orders here. Okay. Orders below here. Why? Because of equal lows. Orders below here because of liquidity prints and lows. And then what price moves on to do is because of the higher time frame liquidity prints within the range, the price shifts and takes the whole range. And once the range has been fulfilled, price slows down because buyers and sellers have been fulfilled. After that, what does price do? Price returns back to the 50% level in the market. And this is the halfway level in the market. So our main objective for the next 5 days is narrative building. Maybe even for the next 7 days is narrative building. Now, tonight we have a Zoom Q&A session. And in this Q&A session, I'm going to be answering all your questions. I'm going to be looking at your homework. We're just going to be doing some extra stuff. But what is your task for today? I want you to go on any currency, right? Let's say, for example, we have USD/JPY. I want you to identify a range, so a high and low point. Let's say, for example, something like this. And then I want you to dissect the price action within the range. Okay, so this is, for example, a range I've identified here. Okay, in this situation, this is a range I've identified here. So we got a high price and we got a low price. Okay, so this is identification of a range here. So all I want you guys to do is try your best to identify ranges and try to narrate the story by breaking the inner section down. So let's say, for example, we've chose a range from back in time. How do you dissect it? So you press the replay button, you go back in time, you say jump to, you move that replay button. Let's say, for example, this is our range and this is the price action within that. You move it here, and then you can go into your 30-minute, you can go into your 15-minute, you can go into your 5-minute, and you can kind of dive deeper into the price action and what has happened. And you should be able to kind of start being able to narrate why this move has happened or why this move has happened, right? And try your best to be able to narrate it. And in the Zoom call, what I will be doing is I will be choosing 10 people's narrations, right? So this is your job. You identify 4 to 5 ranges and you narrate it and you analyze on the chart. So you label what. So let's say, for example, in this situation here. So we have 1, 2, 3, 4. Then we have equal highs here. Alright, and then price pushes up. So we have an LQ tap, kind of an LQ tap here. We know orders are built above here. Okay, so what does price do here? What is this piece of price action? This is a buy side sweep to fulfill liquidity. I don't mind what terms you use, by the way, guys. Yeah? We know orders are orders of liquidity. If you call it liquidity, buy side sweep, so it doesn't matter. As long as you understand the concept, I'm not really concerned with the kind of terminology you're using. So kind of this narration, and then furthermore from there. But I believe I've given enough for you guys to be able to do this exercise. So again, what we're doing, we're identifying a range. So we're drawing a range. And we're kind of trying to break down what has happened in between the range. If you want to go back in the range, what you do, replay button, you go back, and then you use the smaller time frames if you want to zoom in. Use the higher time frames if you want to zoom out and kind of identify what's happening. Remember to go into your daily first. So let's say, for example, if I was using my daily on USD/JPY, I would say the first range that you guys should try to identify would be this one here. So you see, so literally the candle, so look at this very carefully, guys. In this candle here, 20th November 2023, and until the 21st November 2023. Okay? So these 2 points. Actually, do you know what, yeah? Let me fix the task. So narrate the range on USD/JPY between the 19th of November 2023, Ali, can you make note of this? And the 21st of November 2023. So we've got a high low point. I want every single person to narrate. This is the homework. So I want every single person to narrate this range. Okay? Narrate this range and every single thing that has happened there and kind of narrate to the best of your ability. Don't explain to me why this sold or why this bought. Try to narrate it and explain the logic behind the sell side move and the buy side move, if that does make sense. So it is, the homework is, Ali, 19th November 2023. Yeah. That's the high point. That low price is 21st November 2023. Yeah. And analyze and identify or narrate the range. Okay? And guys, take your time to create as art, dissect the charts. Like, look at, if you need to look at something for 10 minutes, 15 minutes, look at it for 10, 15 minutes. But this is your starting process in identifying and narrating the story. Once you get better at narrating the story, we're going to get deeper into it. But apart from that, stay relaxed, stay calm, enjoy this exercise. It's a very beautiful exercise to be doing. And let's go Ezaih Camp 2024. This video is going to be uploaded very shortly. Let's get it.